Hello, everybody, and welcome to our January 2025 AFC Fund webinar. My name is Thomas Hooker, and I'm the CEO and founder of Asia Frontier Capital. With me today are Ruchir Desai in Hong Kong, who is managing with me the AFC Asia Frontier Fund. Ahmed Tabaqchali, the chief strategist of the AFC Iraq Fund, is today in Baghdad, Iraq. Scott Osheroff, the Chief Investment Officer of the AFC Uzbekistan Fund, is in Tashkent, Uzbekistan, and Vicente Nguyen, the Chief Investment Officer of the AFC Vietnam Fund, joins us from Ho Chi Minh City. This webinar will last about 45 minutes, and thereafter you will have the opportunity to ask questions during our 30 minutes Q&A session after the presentations. You can submit your questions online through the Q&A icon at the bottom of this Zoom window on your laptop, PC, or mobile phone. 2024 was another good year for most of our AFC funds. The AFC Iraq Fund was up 43.5% after a 110% increase in 2023. The AFC Asia Frontier Fund gained 23.1% in 2024 after a 2023 performance of plus 27.1%. And the AFC Vietnam Fund closed 2024 with an increase of 10.2%. However, our Uzbekistan Fund suffered again and made another yearly loss, which is in my view a good investment opportunity for long-term investors who follow the buy low, sell high investment principles. Today is the fourth day of Donald Trump back in the driver's seat, and like in his previous 4 years serving as the President of the United States, it seems there will be again never a dull day during his second presidency, since any minute a new market-moving announcement could be sent from his social media account. Ruchir, over to you for the outlook for the Asian frontier markets and the AFC Asia Frontier Fund, please.
Thank you, Thomas, and welcome everyone to our regular quarterly webinar. So I'll get right into it. So as this chart shows you, 2024 performance was, as Thomas mentioned, extremely strong for the AFC Asia Frontier Fund, plus 23.1%, following on from 27% in 2023. So the returns over the last 2 years is about 56% in dollar terms. So a pretty strong run for the fund over the last 2 years. That's predominantly led by markets, as this chart shows you. Asian frontier markets again for another year have significantly outperformed, I would say, many global markets, and especially the regional peers, especially in Southeast Asia. So Pakistan and Sri Lanka were the two best performing markets for the fund. I mean, for us in our universe, and also they were in the top 5 performing stock markets globally in 2024. And returns were pretty broad based across the board for our fund. So returns were led by Pakistan and Sri Lanka predominantly, then also from Vietnam, from Iraq, Kazakhstan, Mongolia, and Georgia. So very broad-based and all-round performance for the fund, again, for second year running. And the main negative contributors for 2024 were Bangladesh and Uzbekistan, but they didn't really affect performance that much because we had such strong performance from the other markets. And I think 3 important drivers which you mentioned in the start of 2024 in our outlook report, in terms of global monetary policy easing in our universe, the earnings and macroeconomic recovery, and also discounted valuations. So the 3 bullet points at the bottom of the slide that you see. All these 3 key tailwinds played out very nicely for our markets. And I think these 3 all came together very nicely for us and for our markets and for the portfolio, which led to the strong performance across the board. And I'll talk a bit about that going forward as well. So that's a bit of a wrap on what happened in 2024. And as the next slide shows you, talking about performance. So as the chart on the top left shows you performance for the fund over the last 5 years, despite all the economic, macro, and geopolitical headwinds the global economy has faced, all markets have faced. The fund is up more than 50% over the last 5 years. You had the pandemic, the war in Ukraine, the war in the Middle East, in general, geopolitical tensions globally. Still, our markets have kind of overcome those headwinds, and that's, of course, our markets have turned around, but also our stock selection has been very, very good, and very importantly, that's done very well for us in terms of a stock selection. That's really helped our performance over the last few years. And also, as the chart on the top right shows you, yes, global markets have rallied over the last 2 years. They bottomed out end of 2022. We saw a rally in the US and some of the other emerging markets over the last probably 18, 24 months. But our fund has really outperformed. So that again comes down to stock selection and being invested in the countries where we thought valuations and the economy had bottomed out, like Pakistan, like Sri Lanka, where we increased the weight, especially in 2023 and 24, which did really well for the fund and really helped the fund outperform all the major emerging and frontier market indexes over the last probably couple of years. So very strong performance. And as the next slide shows you, I think one of the key drivers for strong fund performance across our markets was, yes, macro stabilized, earnings came back, you had more political stability. But the key, like for any stock market globally, was the lower interest rate environment, which affected our markets more because many of the central banks in our universe raised interest rates very aggressively in 2022 when the Fed was very aggressive and the macro headwinds that they faced. So you've seen a very aggressive easing cycle, especially in our universe. As the chart on the top left shows you, Pakistan has been very aggressive in cutting interest rates. The central bank in Pakistan has cut interest rates by 9 percentage points in the last 6 months since June 2024. That was a very important factor for driving returns in Pakistan. Sri Lanka central bank also cut pretty aggressively, and so have some of these Central Asian central banks. And also, as the chart on the top right shows you, I think in general you've seen a bit of an easing monetary policy scenario in some of the global central banks in the developed markets and also in the emerging markets in Asia. And of course, the bigger question is now what happens with the US Fed, with their interest rate cycle, now that Trump is back as president. But I think, as I mentioned last year also, at the same time last year, remember in the first half of 2024, there's a lot of talk about how many times Fed will cut or how many times will they not cut and what's going to happen to the interest rate outlook. But despite that, our markets did very well. So I think the key point here is, our markets have now, they're coming out of a macroeconomic crisis. They're coming out of the issues they face. So they're having their own domestic policies, which are really helping the economy, helping the stock market, helping sentiment. So now whether the Fed does 2 cuts, 1 cut, or 3 cuts, or it just holds for the next 6 or 7 months, I don't think I'm that concerned with respect to how it impacts our markets, because like I said, our markets have entered their own economic cycle. They've got their act together, and returns will be driven more by what happens in, say, Pakistan or Sri Lanka or Bangladesh or Vietnam or Kazakhstan, rather than what happens with what the US Fed does in the next 6 or 7 months. So that's the key. I think I just look at the big picture from here now. So that's the key takeaway from this slide. So I think I'll talk a bit about the outlook now, because that's more important. Returns are very strong, but I think the outlook also remains quite optimistic from my point of view. I think for 2025, possibly one big theme could be, with respect to trade, especially US trade policy. Now that, Donald Trump is the new US president, and has a lot of rhetoric on his trade policies and tariffs with respect to how he could increase tariffs in various countries. So from that perspective, many of our markets and also our fund is very well positioned to kind of face some of these headwinds in case you have a big pickup in trade tensions. So for example, as this chart shows you, exports as percent of GDP for many of our markets is tiny. For example, Pakistan is less than 10%, Sri Lanka and Bangladesh about 12 to 15%, and even Central Asian countries pretty low. So in the event that, you have these trade tensions between US and there's this trade war and trade tensions, etc., happening between US and China or or US and EU, etc., I think our market's pretty well insulated from some of these issues because they're more focused on the domestic economy. And like I mentioned earlier also in my comments, I think they have their own domestic economic cycle now. They've entered into a positive economic cycle. So what happens with, US trade policy or, what Trump says about, say, China or Mexico doesn't really affect them. And in general, I think these countries are not really on his radar. He has lots on his plate. So I don't think he was going to bother about Sri Lanka or Bangladesh or Pakistan or Uzbekistan from a trade perspective at this point in time. So from that angle, I think that they're pretty well versed or pretty well insulated from those issues. But key message from this slide is many of our markets are well insulated from the trade tensions that could occur going forward this year. And as the next slide shows you, I think even though our fund has done very well, our markets have done very well over the last 2 years, valuations are still very attractive. So, for example, our AFC Asia Fund has now reached its all-time high NAV at the end of December. But despite that, the P ratio is at almost an all-time low. So, for example, the last time the fund performance was very strong was when the fund peaked was in mid 2017. The P ratio was about 17 times, and now when the fund has again reached an all-time high NAV, the P ratio is pretty much an all-time low. So that just shows you how discounted valuations are within our universe. And despite Pakistan doing well, Sri Lanka doing well, Vietnam doing well, valuations haven't really re-rated. So I think the next leg of returns, say in 2025 and 26, will be driven by valuation multiples re-rating further because of economic stability coming back, earnings coming back, and political stability coming back. So you have a combination of good factors coming together to drive valuations and returns higher going forward. And I'll just talk about some of our top picks and some of our thoughts on some of our markets for 2025. So I think on the next slide, so Sri Lanka is one of our top country picks for 2025. Yes, it's had a very strong run over the last 2 years, but as this chart shows you, valuations, the P/E ratio for the index is still low compared to where it used to be. So, for example, pre-crisis between 2014 to 2016, 17, the P/E ratio for the index was about 14 to 15 times. But I think so, and besides that, many blue chip companies that we own are still trading at single digit P/E ratios. The banks still trade less than 1 time price to book ratio. So you're seeing a pretty strong recovery across the board. And that four important factors which I think will drive returns in Sri Lanka going forward. So I think one is we've seen a very strong economic recovery in Sri Lanka. Tourism has come back very strongly. GDP growth in the first 9 months of 2024 was about 5.2%, which is well ahead of estimates. IMF and the World Bank were expecting 2 or 3% GDP growth, so it's been much better than expected. Second is the IMF program is going on successfully. Third is you have the sovereign credit rating upgrades which took place from Fitch and Moody's last month, so that's positive for investor confidence. But I think most important is the strong political stability. So you have a majority government in parliament now, and that therefore, you've for the last 5 years, you've not seen economic or political stability. What you have now is both economic stability and very strong political stability. So I think that's going to drive returns. And we saw that, for example, in the fourth quarter of 2024, once the presidential election and parliamentary elections were through, and there was a very strong mandate for the new government, the market rallied by 34% in the last quarter of 2024. And this year already for the first 3 weeks of 2025, the market's up about 5% in dollar terms. So you're seeing that, you're seeing the momentum come through. So I think Sri Lanka could continue doing well in 2025. I would say even the next couple of years because they've got the stability back after 5 tough years. And the next top pick for us for 25 is Pakistan. Yes, Pakistan also, like Sri Lanka, had a very strong run, up 86% in dollar terms. But if you look at this chart, the P ratio still at 6.7 times. Last time the market peaked in mid-2017, the P ratio hit about 14 times. And that time the country was entering a political and economic crisis. The former Prime Minister Nawaz Sharif was removed from power. You had, the country entering election cycle. You had the country entering a macroeconomic crisis. Current account deficit was increasing. Interest rates were increasing. IMF program was not in place. But now what you have is interest rate being cut. Like I mentioned, they're down by 9 percentage points in the last 6 months. Inflation is down to single digits. Election cycle is over. The IMF program is in place. You have relatively more political stability, and earnings are coming out, and the economy's bottomed out. Last time the economy had peaked out in 2017 when the market peaked. This time the market has done very well, a new all-time high, but the economy has not really recovered. And this year and maybe even next year, you see the economy doing much better and earnings coming back. So I think P going back to our long-term average P ratio for the index in Pakistan is about 7.5 times. So I think it can do 7.58 times this year just on earnings and macro and stability and lower interest rates even further from here. But I think longer term, as the next slide shows you, I think politics is part and parcel of investing in Pakistan. It's always going to be some political noise. But the key issue in Pakistan is the politics is one part, but the bigger issue is the balance payments. So we've seen over the last probably decade or so, they've had 3 balance payments crises in 2013, 2019, and 2022-23. So as this chart shows you, if they can manage the current account deficit, which as per the estimates, they should be able to, unless they do something drastically crazy. If it's about 1.5% of GDP in terms of the current account deficit, they should be okay. And then so basically what I'm trying to say is that if they can go through one macroeconomic cycle without a major crisis, then you could see maybe a multi-year rally in Pakistan, which is possible from what I see on the ground, what we see on the ground, what when you speak to people on the ground, it seems like the government wants to have stable growth, not shoot for significant large GDP growth and then have a boom bust cycle, which has been the history of Pakistan. So hopefully they've learned from their past mistakes, but we'll see. It's still early days. I think a call on this would be better to take, maybe end of this year, beginning of next year, to see how the current account is doing, how exports are doing, how the foreign exchange reserves are doing, and in general, how policy making is going through for Pakistan. I think 25 Pakistan should be okay, but beyond that, I think this is what matters most for seeing a multi-year rally in Pakistan, because valuations, like I said, are very cheap. Blue chip companies are less than, as the chart showed you in the previous slide, less than all single-digit P ratios. So most blue chip companies in Pakistan, and they're very well run. One more market we like in general for the long term, but which could do well in 2025. And I say it's a dark horse because for me it's similar to what Pakistan, or it's in a similar situation macro wise and stock market wise to where Pakistan and Sri Lanka were maybe 2 years ago. So so investors are very skeptical, very depressed in terms of the outlook. As this chart shows you, valuations for the index is about 9 times. Basically, it's halved in the last 4 or 5 years. So sooner or later, I think you'll see a re-rating here, because I think over here also in Bangladesh, you're seeing the macro kind of stabilize. For example, despite all the issues it faced, the last 3 months, exports have really picked up. Exports in general, for garment exports specifically. Garment exports have been doing, mid-teens growth over the last 3 or 4 months. You've seen the current account stabilize. You've seen foreign exchange reserves improve. So you're seeing all the economic indicators kind of stabilize. I think inflation also should peak out by the first half of this year, and even interest rates should peak out by the first half of this year. So I think once the market has a sense that inflation has peaked out, interest rates could start getting cut from 2026, you could see a rally. Same thing happened in Pakistan, Sri Lanka in 2023 and 24. So maybe Bangladesh follows the same trend. So this could be something which stands out. But in general, a market to watch out for the next couple of years. And one more theme which we think could play out maybe 25 or 26, but over the next probably 1 or 2 years, is Central Asia. So some of the stocks we own in, say, Kazakhstan, Georgia, and also the Uzbekistan fund, the valuations in these countries slash companies have got derated since the war in Ukraine in February 2022, as this chart shows you. So these are two stocks we own in Kazakhstan for the AFC Asia Frontier Fund. One is listed in London, one Kaspi, which is listed in US, and Halik Bank, which is listed in London. Especially Kaspi, which is a fintech, very profitable fintech company. The P ratio has basically gone from 17, 18 times to about 10 times. And Halik Bank was about 4.5, 5 times before the war. Now it's about 3.5, 3.7 times. So I think if obviously it's a big if. We don't know. I'm not an expert on Russia-Ukraine relations and what the US could do. But if something does work out over here, some kind of compromise, then you could see many of the stocks from this region re-rate. From Georgia, from Kazakhstan, from the Uzbekistan fund as well, because all these stocks have got a bit of a geopolitical discount now, because of the fact that they're in the neighborhood. Some of them border Russia. They have close maybe trade relations or cultural relations with Russia slash Ukraine. So they got a bit of a geopolitical discount. So this is something to watch out for. And also, if this happens, then it helps these countries, and also it helps the fund performance. So that's some of our top picks for 2025 and some themes that we like for 2025. And as the next slide shows you, the earnings momentum also should continue. I think, like I mentioned, many of these economies like Pakistan, Sri Lanka, they've entered a positive economic cycle. The worst is behind them. So you're seeing lower interest rates now lead to higher loan growth, higher consumption, higher domestic activity, higher manufacturing activity. So you're seeing earnings coming back. So I think earnings will be led by Sri Lanka next year also. They've been very strong for the last 6 months in Sri Lanka as well. Vietnam GDP growth about 7% for 2025, which will also be pretty good for earnings growth. And Pakistan, again, lower interest rates and in general economic activity coming back should drive mid-teens earnings growth. So I think earnings also will be one more key factor which will support the valuation re-rating story, besides in general stable economics and stable a stable political environment. So I think just to wrap up, in terms of the key message that I want to send on the next slide. Yeah, so I mean, in general, 2023 and 24 were very strong years for the AFC Asia Frontier Fund. I mean, pretty much what we predicted or anticipated played out, and we positioned the fund very well in terms of country allocation and stock selection to benefit from those gains. So I think the fund is entering 2025 on a very strong footing. So I mean, fundamentals obviously are very strong. They've been very strong, for the last couple of years. Valuations are very attractive. You have high ROE, strong earnings growth. So I think I'll just reiterate, our top picks for this year, Pakistan, Sri Lanka, Bangladesh, like I mentioned, could, be the dark horse. I think it can turn the corner later this year. Central Asian stocks should possibly do better if there's some kind of compromise in Ukraine. And I think if trade tensions pick up, then I think our markets are, and even our fund is very well positioned compared to, say, Southeast Asia, which is very trade dependent. And so I think they could have relative outperformance from South Asian and Central Asian frontier markets if trade tensions pick up. So I think, I think in general, 2025 should be pretty strong year again for the AFC Asia Frontier Fund. I think the key risk is, a key risk which is realistic. I mean, I'm not talking about major events like, say, a pandemic or some kind of war, but something which is more realistic is, for example, policy making, say in Pakistan, Sri Lanka, Bangladesh, or some of the other countries that you own, they don't follow through on some of the policies. Or there's policy paralysis. That could be the risk to the re-rating story. But in my view, I think they have no choice but to follow through. And that's why you've seen, make countries like Sri Lanka and Pakistan and even Bangladesh following through on reforms, because I think in my opinion, they have no choice now, because they were in such a bad, I mean, the crisis they faced in 2022 was existential. So they have no choice but to follow through incrementally on doing these reforms. Maybe they won't happen as soon as people expect, but they will happen at some point. And like I mentioned, because the issues they faced were very deep and very structural, and they have no choice now but to follow through, given some of the issues that they faced over the last few years. So yeah, just to wrap up, I think the tailwinds are very much in place, or continue to be in place for our fund and for our markets for 2025. So 2023 and 24 very good, and expect 2025 to be good as well. So yeah, if you missed out on the last 2 years of good performance, it's still not too late to get some of those tailwinds into your portfolio. So with that, I'll wrap up and hand it over to Ahmed Tabaqchali, who is the chief strategist of our AFC Iraq Fund. Over to you, Ahmed. Thanks.
Thank you, Ruchir, and thank you everybody for joining in. Right, okay. So as Thomas argued or mentioned earlier, that we've had actually the whole AFC Iraq had a fantastic couple of years, as maybe worth repeating. We were up something like 110 plus percent for 23, and then we were up 43.5% for last year. So if you look at the 2-year views, almost 300%. Since inception, we are sort of we're 105, way outperforming our index. And the question really comes in is, after 2 such years, what is next? I mean, for new investors and current investors who would look at something like this and say, okay, we've had 2 great years. What next? What will drive them? The answer, by the way, it pretty much goes back to fundamentals and goes back to long-term investing. And in a way, next slide, Peter, please, will I answer that? Yeah. Okay. So the answer is basically the same answer we gave last year at the time when we had one gangbuster year, and the question was, what would there be next? And the thing is that the same fundamentals that drove 23 took part in 24. They are part of our long-term investment thesis on Iraq, as Thomas and my other colleagues will argue, or have argued in the past, that we are long-term investors. So when we looked into Iraq in 2015. Iraq at the time was a country that had generally sort of like 33 what we thought were really, really positive things. One was the fact that it was emerging from conflict. So you have that conflict to drive, the returns that would come in after you get out of conflicts. 2, you have a country that is actually exceptionally young with a very young population. So that on its own will drive the market going forward. And finally, the rebuilding and joining up with the world. Iraq was pretty much isolated until 2003. We pretty much were almost like, in a cocoon away from the whole world. And we missed out on a lot of developments. One of them was internet. The other major one was banking. So in a sense, the long-term part of it, 2 of these things came into fruition in 23, and they were developed further in 24. The first was the relative stability that the country enjoyed over the last few years. We've had, according to our history, I'm not saying to everybody like, COVID or Ukraine, where not major events, but for Iraq, they were really, relatively speaking, very minor events compared to what we as a country experienced since 1980. So in a sense, that gave the the individuals, private businesses, the government room to spend in a sense, because there was a degree of predictability, a degree of macroeconomic predictability that allows them to spend in a big way. And we've seen a massive expansion in our rebuilding, infrastructure rebuilding. And anybody who comes to Baghdad will be amazed. Those who come to Baghdad will see and think, oh, could be a replay of Dubai. Obviously, very different things, very different dynamics, but Baghdad is a city of almost 10 million people that hasn't had any real infrastructure built. So let's give you a concept. The other one was the significant development that took place in November 22 as effect to how we interact with the outside world. We are a country that imports almost everything from the outside world, and so therefore how we pay for those and the banking system plays a big role. The changes there drove the adoption of banking. We are a cash-denominated economy, so cash drives almost everything. Almost all transactions were driven by cash. So development, what they did is that they accelerated the adoption of banking, and in the process, transforming the sector and its role in the economy, and with it, the usage of banking system. And no economy can grow without a development in the banking system. Anybody who's seen countries that emerge from conflict or countries that emerge from the environment Iraq was in, even if you remove the conflict, the isolation and adoption of banking, you'll see that drives the economy in a big way. So those two things came into fruition in 23, and they developed further in 24. Now, they were supported by relatively higher oil prices in 21, very high oil prices in 22, and sort of benign oil prices in 23 and 24. All of them gave the government enough wherewithal to go and spend significantly on super expansionary budget. So they've supported all of this. Next slide, Peter, please. Right. We believe that these same dynamics will develop further in 23, and in 25. However, having said that, we believe the acceleration that we've seen will slow down somewhat. Mostly, the biggest reason for that is at a higher base. Everything we have now comes from a higher base. So the growth will come in from a higher base, and we should see a deceleration in deceleration in the earnings profile, especially of the banks. These have had phenomenal year-over-year growth and had great quarter-on-quarter growth. We believe that they will slow down. Now, the interesting thing in that they will slow down, but the growth will come in from a sector which has fundamentally substantially better dynamics, better economics, and also better financial footing. And we believe the growth will come from there on a higher base. Same thing is for the benefit of stability. We've had now a stability, so therefore everything builds up on existing larger base. And same with the super expansionary budgets. Non-oil GDP expanded significantly in the last couple of years. Having said that, the interesting thing and the promising thing about that is that we will get to a new normal in earnings. A new normal in earnings is very important to allow us to look where things go from here. It's still too early to arrive at the new normal because growth is still very strong quarter on quarter. But over the next few quarters, we should see where the dynamics will be. And the interesting thing in that is that with that, the whole world will begin to see what Iraq is and what the earnings profile is. And therefore, what I'm saying right now, apart from, for a number of people might be seeing like heresy or fantasy, that will be seen as reality by most people because these things will be well entrenched and well obvious. So next slide, Peter, please. Having said that, I mean, we've had some other positive things. I'll go in very quickly. What contributes, and I think they should look pretty promising looking into 25, is that a lot of the risks were reduced or dialed down that affected us. For example, as everybody knows, end of 23, we've had the war on Gaza and the ensuing conflict, and that what it did basically, it raised the risk profile enormously for a place like Iraq. And we've seen in the report that I've written in the last few months is that actually our market has pretty much ignored these and was discounting the dynamics I discussed earlier. Nevertheless, these things have all dialed down significantly or diminished significantly. So you have the truce in Lebanon, you have the developments in Syria, and the Hamas-Israel tentative ceasefire. On top of that, we have the international community's efforts to stabilize, and this what it's doing is that hopefully it means that these could be entrenched. In the background, oil prices are more promising. They firmed up late last year and they continue to be relatively strong. I'm not arguing that these things, by the way, would look super high oil prices. I think that's unlikely, but prices should be for Brent between 70, a range of 70 to 75 versus last year 75 to 80, which is relatively positive for us and building story. Now, all of this would say that the risk premium on investments in the region and Iraq might come down or would come down. I certainly not counting on that, simply because I haven't seen yet any substantial foreign interest in Iraq. Only when that happens, suddenly the belief in that will take place, but it's definitely a positive. And next slide, I think it's the last one. Right. Okay. Coming into the usual sort of thing, risk is always on available and is always there for any investment in the Middle East, and Iraq is no exception in that. One of the risks could be that these developments I discussed in the last slide might not be sustained, and a conflict will resume and it will become substantially worse. That is certainly a possibility. I don't believe that, but I think certainly it is a possibility and a reasonable probability that could happen. And the other one is, as Thomas was arguing, we're going to have a very interesting, or I don't know which other way to use it, very interesting next 4 years with the current presidency in terms of the changes, in terms of the suddenness of stuff. For us, it will come indirectly through the US policy on Iran. Because most of the policy towards Iraq in the last few years have been driven in the US, have been driven with an Iran lens or Iran angle. So the return of maximum pressure could very well have an effect on us. How would that happen? Well, I think it could happen over 3 ways. One, at the time when the maximum pressure campaign happened, that happened on our official imports of gas and electricity from Iran, and also even our trade with Iran. That could affect us. At the time, it didn't affect the investment landscape because the US gave us a number of waivers to continue to import electricity and gas. That is a risk. However, the economy is significantly, or mitigating factors, is the economy is significantly different from then. In 2016, when Trump had his presidency, and then he had the leaving the JCPOA in 2018. At the time, we as a country looked very, very different. We just at the time just emerged from the ISIS conflict and from very weak oil price. So we were very, very weak then. And none of the stuff I mentioned was not even remotely happening, or actually was really underground. So that I think is a very different factor. And finally, I think personally, a huge mitigating factor is the timing of the Hamas-Israel agreement. As we all know, or pretty much basically I should rephrase, where we all heard that this agreement that the two sides have accepted were the same one on the table put in May. However, that was driven by the Trump presidency. And that tells us that basically it could very well be the transactional nature of the administration could very well be promising for the region, i.e. maybe a grand bargain with Iran, or maybe a grand Middle East peace that will give all kinds of Nobel Prize peace, what have you. So all of these things could be possibly. Could they happen? Who knows? But I think it's a possibility. The one interesting thing I think which will happen for Iraq, irrespective of that, is the domestic US policy when it comes to oil and gas. I think basically the changes we've seen in the last 4 days, and likely in the next one, will pretty much prolong the oil age by easily another 5 to 10 years, which for Iraq is positive given our leverage to oil prices. So these are mitigating, that they will continue to mitigate the risk, but who knows? With that, I think I might have exceeded my time, and thank you all, and passed on to my colleague Scott, who looks after our, apologies, my deep apologies, I took too much time. I'll give it to my colleague Scott. Thank you very much all.
Good day, everyone. Next slide, please. So touching on something that Ruchir mentioned, when you look at the broader sort of Central Asian region and the difference between perceived and actual risk, of course, since the conflict in Ukraine started, you've seen equity prices largely been impacted by what's going on in Ukraine. But the reality is that Central Asia is probably one of the safest places in the world. I'm often asked, is Russia a threat? No. For Uzbekistan, you look at their border with Afghanistan. Is Afghanistan a threat? No. The reality is that actually Uzbekistan is one of the safest places in the world, contrary to the popular perception. but there was a security perception index survey that was done, I guess, last year. And in 2023, Uzbekistan was rated the safest country in the world. So unfortunately, this difference and the arbitrage opportunity exists throughout the broader region, but specifically in equity prices. The irony is that when you look at what actually happened when the conflict in Ukraine started, is that the Uzbek economy went into hyperdrive because you saw a relocation of largely the key sanctioned industries, directly or indirectly, but financial services and the entrepreneurs and these people left from tech and finance out of Russia and poured into Central Asia. This, along with the huge amount of movement of capital, helped really stimulate growth in the region. But the reality is that equity prices haven't reflected this. And in due course, I imagine they will. So again, the Uzbek economy has done really well over the past few years, but this is not translated into robust action in the equity market. And actually, when the conflict started in Ukraine, you saw a handful of foreigners look to sell, but equally you saw a whole lot of locals panic because they expected a wider war to take place, and they were dumping their, in some cases that I'm aware of, not unsubstantial um, uh, equity portfolios into the market, and there were very few bidders at the time, so prices fell, and that's part of the larger result of what's happened over the past 2 years. As you've seen foreigners pull back, locals haven't been too active, and the market has been weak. But the reality is that the underlying companies that we own are doing very well, and the economy is doing very well. So in 24, you saw GDP growth of 6.5%, and the economy reached about $115 billion. Keep in mind that the gray market economy is 30 to 40%, most likely. So you're looking at something closer to a $150 billion economy, which is why, for those of you that have visited the country, you see that there's a very big difference between reality on the ground versus what you look at in the statistics. There's a lot of money there. Equally, Uzbekistan, as I've said over the years, is going to become, in my biased view, but I think it's correct, the largest economy in Central Asia. And they're also in the process of becoming the key logistics hub and sort of aviation hub for the broader region. And you look at flight connectivity, the country that has the best flight connectivity in the region is bar none Uzbekistan, whether it's to the States, to China, Southeast Asia, Europe. It puts Air Astana to shame, even though Air Astana out of Kazakhstan is a better airline. Uzbekistan Airways and then all of their partners with airlines from the broader region, what I call the New Fertile Crescent, is helping to really drive, tourism among business. So in 24, you saw 30% growth in passenger arrivals at Uzbek airports, up to about 13.5 million. So again, it's a very exciting story. But nonetheless, over the past 3 months since our last webinar, there hasn't been a whole lot of news on the capital markets. The big one is that the Tashkent Stock Exchange finally integrated quotations with Bloomberg in November. They're still a bit buggy, but nonetheless, they're there. And hopefully in due course, we see them on board OTC companies. Nonetheless, this is a good first move in the direction in relation to what we've been seeing develop in the sandbox regime, with also international custodians coming into the market. And the next big one is going to be Clearstream. So we have a meeting with the CEO of the Tashkent Stock Exchange next month and hope to get more information on this. But again, the key driver for the equity market going forward is going to be seeing the barrier to ease of capital coming into the market being eliminated, and that's going to be through Clearstream. So we were initially told that you'd be able to trade via Bloomberg by the end of last year. We assumed that wouldn't be the case. And then we were also told that by fourth quarter of 24, we should see integration with Clearstream. As I might have mentioned the last webinar, if it happens in the first 6 months, 9 months of this year, we'd be equally happy. Things always take longer than expected. So we've learned, especially in Uzbekistan, that when the government announces something, discount it significantly when it comes to time frame for development. So this infrastructure is key. And yeah, the broader economy continues to do well. No doubt there's a bit of strain in the debt market, if you will, because there was a huge credit boom in 2017, 18, 19, and this got a lot of locals leveraged up to buy real estate, autos, and appliances. But nonetheless, so you might see a bit of slowdown in consumption, but that's arguably not a bad thing, because hopefully we start to see that, along with rising exports, eat away at the trade deficit. So again, the long-term story is great. It's just a matter of patience, which frustrating, but nonetheless, Central Asia expansion on sort of the global stage and attraction to investors is a longer-term story. The valuations of the companies we own are attractive, and the economy continues to do well. So with that, I'll pass it off to Vicente Nguyen, the CIO of our Vietnam fund.
Thank you very much, Scott. So first of all, I would like to share with you the story about Vietnam's economy in 2024 is an amazing year of the country. So in 2024, the GDP growth reached 7.1%. This is one of the highest level that the country can achieve in the last 10 years, except for 2022, is particularly of the COVID-19. And the economy grew aggressively in 2024, thanks for the industrial productions with 8.4% and the very stable FDI disbursement with 9.4%. Particularly, the exports of the country strongly recover and make a 14.3% growth in 2024. Especially the export revenue of the country reached the new record high together with FDI disbursement of the FDI disbursement. So with those kind of factor together with the retail consumptions, so Vietnam economy has a really outstanding year in 2024. Based on the outstanding achievement in 2024, Vietnamese government already set their GDP growth target in 2025 with very ambitious level is 8 to 10%. The question is, how can they achieve this number? Please go to the next. Actually, Vietnamese government already make their master plan for 2025, and this is some factor that they will focus in this year. The first thing is the public investment activities. So after Vietnam has the new general secretary, it means that the real leader of the country was elected last August. So, the whole political system right now is looking forward to the future in one direction, and they ambitious to deploy a huge public investment activity with a total capital of more than $32 billion US. Is roughly around 7 to 7.5% GDP in 2025. Another thing is the consumptions. So government continue to support domestic consumption, even though in 2024 consumptions growth was very high, but most likely because of the tourism. The domestic consumption was still low with less than 5%. So the government decided to push the domestic consumption, and we expect that it will strongly recover in 2025 to contribute to the target 8 to 10%. Another thing is tourism. So last year, tourism really recovered and almost reached the record high, in the history with 17.9 million compared to 18 million in 2019. So we expect that the international tourists will come to Vietnam, will increase approximately in 2025 and can reach 21 to 22 million international tourists. And this tourism industry will contribute quite a lot to the GDP growth in 2025. Another thing is the export. Even though Trump really make investor and entrepreneur worries about the outlook for Vietnam when he could put a tariff on not only on Chinese product, but also Vietnamese product. However, based on the fact, the past fact, during the first his presidencies, the export of Vietnam from Vietnam to US double during his first presidency. So he really liked Vietnam. He is the only US president until now visited Vietnam twice in one term. So, and recently, here's the Trump organization already announced an investment in Vietnam when he decided to invest a golf course in the north, and Tesla of Elon Musk also invested 1.5 billion US dollar to build a factory for the SpaceX products. So with this kind of thing, we think that Vietnam will not take that kind of risk in the second presidency of Trump. And even if he put 10% on Vietnamese product, is still favorable for Vietnam because it compares to 40 to 60% of Vietnamese product for Chinese product. So it will encourage Chinese companies to move their production from China to Vietnam to produce and export for US. So with this momentum, we strongly believe that Vietnamese government can reach their target in 2025. Go to the next, please. So how we can capture the growth of the economy? And right now, the whole portfolio of AFC Vietnam focus on three main sectors: exports, consumption, and public investment sector. We already invested in these three sectors in the last in 2023. And last year, exports really performing well for the whole portfolio. Consumption not really good. Consumption also recovered, but the public investment sector didn't act that much because, as I already mentioned, that the General Secretary of Vietnam was elected in August. So from January to August, almost all activity was delayed. And after August, since September, everything speed up again. And right now, when we have a new leader already, we strongly believe that the public investment activity will be stronger again in this year. So we expect that the public investment sector will be one of the key growth factor for AFC Vietnam portfolio. For example, I would like to share an example about TNG. One of the top 5 position in our portfolio is the clothes exporter with 50% market share in US. And last year, when the exports recover, the revenue and the net profit of this company reached the record high. And the company already invested another factory and plan to expand their revenue to $1 billion per year. So with this target, I am very confident that this company will make another record high in their stock price. Go to the next. So actually in December and January, the stock market of Vietnam was not really good because of a lot of investors in Vietnam with 95% is local individual investor. They really worry about Trump presidencies and what he's gonna do. A reason why they almost, how to say, hibernate from the market trading, daily trading. When the market liquidity dropped down 25 to 30%, is make the VN index drop down, and right now is trading below the move, the MA 200 day. So I think, in my point of view, is a quite good opportunity to buy because of the economy and the enterprise earning was pretty good when they continue to recover from the low of 2023 and continue to grow strongly in 2025. The Another thing is the emerging market upgrade in 2025 is quite firm after Vietnam already approved the non-pre-funding regulations, and Vietnamese government is working very closely to FTSA to promote Vietnam market to emerging market. And the earning growth of AFC Vietnam portfolio is estimated around 20 to 25% based on consumptions, recoveries, exports growth, and the public investment sector. So thank you very much for listening.
Thanks everybody for your always interesting and insightful presentations. We will now answer some of the many questions we have already received from the participants. But you can still submit more questions during this Q&A session through the Q&A button at the bottom of the Zoom screen. The first question we have is actually from Bloomberg. So it's, hi Ruchir. Pakistan had a banner year for its stock market. You mentioned your optimism, but you do see scope for foreign investors and thereby foreign investments being a key catalyst for market performance this year? Question mark. Could we see more foreign funds taking positions?
Yes, thank you for the question, Chiranjeevi. So I think in general, for many of the markets in our universe, performance, stock market performance in Pakistan and Sri Lanka, even Vietnam for that matter, has been driven predominantly by local domestic investors the last few years. I don't expect that to change significantly even this year. But yes, if, for example, if Pakistan continues doing well, say into the first half of this year, then it comes under the radar of more foreign investors. You could see some foreign investors come back in the market, and you've seen that happen in the last probably 6 months. When the interest rate cycle started reducing and the State Bank of Pakistan began cutting interest rates, you've seen some foreign flows come back, and some more positions, some more funds are taking positions. In fact, Thomas was in Pakistan a couple of months ago with other foreign investors. So seeing some interest come back. But I would say, yes, you could see some interest come back in Pakistan from foreigners, but predominantly, I think the returns will still be driven by the domestic investors.
Yeah, that's right. And I have to say, there were not too many foreign investors, just a handful. No Americans, because I think there's still a travel warning to Pakistan. So many US fund managers, they cannot travel to Pakistan, unfortunately, because it's really worthwhile to see what's going on the ground. It's very different what you read in the newspaper. Then there's a second question also from Bloomberg. Secondly, you mentioned about foreign managers being insulated.
Frontier markets.
Frontier markets, yes. It's always this problem with abbreviation. Okay, about foreign frontier markets being insulated from trade war. Do you see global money managers being more interested in frontier markets this year for diversification purpose going ahead as a hedge against related volatility? Question mark. Yes, I would love to see that, but Ruchir?
Yeah, I think the way what's played out so far, like Vicente was mentioning, in Vietnam, you've seen pretty significant foreign outflows actually, the last probably couple of months, couple of quarters. So they're leaving some markets because of potential trade tensions between large exporters to the US like Vietnam, because of potential tariff issues. How that plays out, time will tell, but you've seen some of those outflows happen. Now those outflows it's not like they've come to Pakistan or Sri Lanka or Bangladesh or Kazakhstan or Iraq. I'm not sure where they've gone, but yes, I mean, in theory, if the trade tensions do pick up significantly and investors start looking for countries and markets which are more domestic focused and more insulated from significant trade tensions, then you could see some of these investors look more actively at Pakistan, Sri Lanka, Bangladesh, Central Asia. But in general, I would expect them to, irrespective of what happens with the trade war or trade tensions, like I mentioned in my presentation as well, these countries have now entered a positive economic cycle, especially Pakistan, Sri Lanka, to some extent Bangladesh. So that itself should drive investors coming back. Plus valuations are very attractive compared to, say, some of the larger emerging markets in Asia. That itself should drive, some foreign investors coming back to these markets, in my opinion.
Okay, thank you. And questions to Ahmed, regarding Iraq, are the returns for the Iraq fund in local currency or in US dollar terms? So I can answer this, yes, they're all in US dollars since inception. And basically, the last 2 or 3 years, when they pegged the Iraqi dinar to the US dollars at 12.90, 13.20. So basically, the return in US dollars and the Iraqi dinar is more or less the same. But there's a second question from the same person. How political stability will impact the economic developments expected in Iraq, given the situation in the Middle East? How is this going to affect Iraq? You're on mute, Ahmed. Mute.
I am mute. I've been using this for years and I keep on forgetting to press the unmute button. So apologies for that. Okay, thank you, Walid. I think it's a very, very interesting question. Yes, I think in a sense, by the way, I'm going to be somewhat optimistic, and it's always very difficult to be optimistic in the Middle East. It doesn't pay to be optimistic. However, having said that, for Iraq, we have multiple things taking place. I think for us, we have elections happening in October of this year, which means basically we were likely to have some sort of political instability, or as usual, it's been sort of a very like all election years. However, having said that, almost everybody is interested in garnering as much votes as possible. And so given the backdrop of benign oil prices, and for me, benign is current level 72 to 75 is pretty much positive for us in the next few years. And as I said to you earlier, one of the things that I'm increasingly coming around to is the Trump presidency and its own domestic policies, and also the changes as well with all the banks, for example, leaving various sort of green initiatives or what have you. I think it probably what it means is prolongs the oil age and prolongs the investments in oil. So it doesn't mean high prices, because I think more US production means lower prices globally, but nevertheless, it probably extends that. Whether that's good or bad, I'll leave that outside. But in terms of investment for Iraq, that adds significant amount of liquidity to all governments in the next few years. So for us, it's going to be that. So we're going to have expansionary budgets, and all of these things would be quite positive for us. Domestically, it's regionally, all developments are positive. So far, we have very positive noises from Syria, and even more positive responses from the US and the Europeans. The situation in Gaza seems to be holding. Okay, a week or a few days is not enough, but there is sufficient reasons to believe it will extend. So overall, in the region probably means dialing down. And if there is a Goldilocks scenario, which again is very difficult to believe in, whether there is one, you'll see reconstruction of Syria, reconstruction of Gaza and Lebanon. All of these things would be positive in terms of money flows into the region. Having said that, as I said to you earlier, the caveat is, it's Iraq and it's the Middle East, so you always have to be somewhat cautious.
Okay, excellent. There's a question for Scott regarding Uzbekistan. Who are the main investors in Uzbekistan? Maybe you should here differentiate between foreign direct investments and equity investment or capital market investments.
So for foreign direct investors, it's largely China, Russia. China's coming in a big way in broader Central Asia, for example, just a tangent. You have the Power of Siberia 2 pipeline, which is a natural gas pipeline. The first one goes through the Kamchatka Peninsula into China, and the Russians and the Chinese want to see another one built. But the Chinese want to go through Kazakhstan rather than Mongolia. So certainly you're seeing a lot of Chinese investment influence in the region. Turkey as well is a big investor. And then probably over the past 3 years, you've seen a huge amount of investment. And it seems like a war for influence between the Gulf states. You have Qatar, the UAE, Saudi, all investing billions of dollars in mainly infrastructure projects and a whole lot in renewable energy generation. And then in terms of the capital markets, you have a handful of Russians, Turks, Kazakhs, and then you have retail and institutional investors from Europe and the States.
And some Swiss investors. Question for Vicente. Do you own banks in your fund currently?
Yeah, at the moment we have roughly around 10 to 11% of our for the banking sector. However, we are still very cautious with the banking sector because of the NPL of the whole banking sector caused by the real estate crisis. So the reason why we do not own that much, only around 10 to 11% for the whole portfolio.
Okay, thank you. Then question for Ruchir. Two questions from the same person. I put them together. One is, which frontier markets have issues with capital repatriation that the fund will have issues with proceeds from sales? And then the same, what AUM can the AFC fund manage without compromising liquidity issues?
I mean, as such, we've not faced any repatriation issues as such. Not like we have our money stuck in a specific country and we've sold something and we've not been able to get it out. And it really depends on the situation or the macroeconomic position of that country. For example, in Sri Lanka, I remember in 2022, beginning of 2022, we sold before the crisis. And because there was like, they had lower amount of dollars in the system, it took probably more time than usual, but we got it back. It's not like it was stuck over there. And I think Bangladesh also, we've not really had any issues as such, even though they've had some macro issues the last couple of maybe 1 or 2 years. So yeah, we've not had anyone impose capital controls on us in terms of saying that you can't take your money out. Maybe it takes a couple of more days more, but no issues as such from that perspective. And that's where our fund management or investment strategy comes into play. We follow a top-down, bottom-up approach, which I can touch upon here. So bottom-up is stock selection, but top-down, we try and get the macro right. So we don't want to have, say, 20% in a specific country, which is expected to enter or going through a macro crisis when therefore our capital is stuck over there. So that's why we reduced our positions in Sri Lanka significantly in the first month of 2022 before the crisis. We didn't do even one trade in Pakistan in 2022, 0 trades in Pakistan. We only did one trade in Pakistan in the first half of 2023 until situation improved. So that's how we kind of manage the whole capital repatriation part. And the second is how much AUM can the frontier fund manage? I think easily $100 million. People think, many investors think the frontier markets are illiquid, but that's not really true. Vietnam, day liquidity on a good day is $100 million. Pakistan's doing $200 million a day now in terms of daily volume. Sri Lanka is doing almost $30 million a day. Bangladesh on a good day can do $100 million. And like I mentioned, some of the, many of the companies we own in Georgia and Kazakhstan are listed in London and US. They're quite liquid and you can allocate a pretty large amount to those countries. So I think easily the frontier fund can do $100 million because you have global frontier funds who are managing $400 and $500 million doing global frontier markets, and some of these markets are not liquid at all. So I think Asian frontier markets and the AFC Asia Frontier Fund can easily manage $100 million pretty easily.
Yeah, just to add on regarding repatriation issues. Of course, you cannot, in certain countries, just press the button and you get in a fraction of a second the US dollars into your account. Sometimes there's paperwork involved. That's normally done by our custodian bank. So it's in Vietnam, for example, we have to fill out some paperwork, the same in Iraq. So yeah, certainly it's less easy, but so that's also good for us. It's the barrier of entry is higher, so it needs some expertise to maneuver through this jungle. But there's another question for Vicente. Do you think the 8 to 10% GDP growth in Vietnam is really realistic?
In my point of view, if Vietnamese government and the political system is really determined and decisive, and they will spend much more for the public investment this year, I think it's realistic, because last year they already make a plan, but they couldn't spend that much money, even though they already deployed a lot of big projects like South and North Highway. And this year, it probably is South and North Rail High Speedway. So if they really deploy those kind of projects, I strongly believe that they can reach around 8%. 10%, I'm not sure, but 8% is possible indeed.
Okay, sounds good. It's probably the best, one of the must be the best performing country this year if Vietnam really achieves that.
Yep.
Great. Then Scott again. How is the country working to address its ongoing power shortage and demand surges?
Yeah, I mean the broader region really has power and energy issues. I mean, even Kazakhstan, which is a huge oil and gas producer, is importing gas from Russia. So Uzbekistan in particular, for some reason that I'm not aware of, and I've spoken with people in the development bank sector about this, the country is very focused on investing in renewable energy. They want to achieve, so they say by 2030 to have 40% of their electricity production from renewables. Now, if you look at any quality reports on renewables relative to the grid, really once you get above 12, 15% of the grid being supplied by renewables, you have perpetually greater grid instability. And you look at Vietnam, which Vicente, I want to say that this was in one of your monthly reports, but Vietnam shunned nuclear a handful of years ago, and now they're talking about building nuclear. The fact that Uzbekistan is the seventh largest uranium producer in the world and doesn't have any nuclear power plants, in my view, is crazy. Now, as I said to the government for a handful of years there in meetings, is that they really need to harness nuclear, and I imagine they will at some point once they start to realize that they've sort of veered off course with this whole renewable game, because he who has a big nuclear fleet in Central Asia is going to be basically the battery to the broader region, sort of like Laos is to Southeast Asia or to Indochina. And Kazakhstan, just a tangent real quick, Kazakhstan has announced that they're building one reactor outside of Almaty. They've already announced they probably need to build more. So if you look at the growing population in Uzbekistan, right now the marginal supply is coming from wind and solar. You have a lot of Chinese and Gulf state entities that are investing in the country and offering very attractive deals for the Uzbek government, which is all take and pay. So at some point, I imagine they're going to probably make a shift to a bit more natural gas, but also hopefully a very hard shift to utilize uranium in the ground and build out a strong nuclear fleet.
Okay, great. Yeah. Ahmed, we have a lot of questions this time for you regarding Iraq. So what is the role of foreigners in the Iraqi stock market? Are they buying? Are they selling?
Actually, they're not there. Unlike the last time the market cried, there were a lot of funds. Right now, as people might not know, but there's only a couple of funds left in Iraq, us and another fund. Foreigners have been mostly absent from the country. The current rally, foreigners took part in it, but mostly repositioning, but no new inflows that the market has seen. I think that, by the way, everything that we've seen so far is driven by domestic and local thing, and it's really promising in two aspects. One, the domestic, we are seeing a lot of like fresh money coming in domestically, and it's mostly people who have discovered that we have a stock market in Iraq. There's a large part of the population, actually, including even officials who have no idea that we have a stock market. So they've discovered that, and a lot of people have begun to invest. For us, investment was only in real estate, like pretty much all, I would imagine, frontier countries. So we're getting a growing domestic user base, which I think is quite positive. As I said in one of the slides, once the outside world begins to see the reality of what's happening in Iraq, away from the stories of horror and nightmares that they've seen in the last few years, and see the thing, I think once foreigners enter in, we could have a substantial rise in the market, just simply with long-term money coming in. By definition, most retail investors are very short-term, while institutions hopefully are long-term. That should be quite positive for the country, or for us actually as well, because we are well in place. It's difficult to buy stocks in illiquid frontier markets. So thank you for that.
Yeah, and I think we see that in several markets in the frontier universe. That's, as for example in Uzbekistan, that there's the local population doesn't know that there's a stock market, has not discovered it. They don't know that you can make money with the stock market if you invest long term and instead of properties and so on. But yeah, time will tell. Sooner or later, we will see that this will also happen in Uzbekistan and in other countries. Then another interesting question for Ruchir. Historically, how have frontier markets done in a strong US dollar environment?
Yeah, I think the question, I guess, is concerned about, for example, if the dollar strengthens, then because maybe some stock markets, capital markets have a lot of dollar investors, so you could see capital flight, which affects the currency. But I think in many of our markets, there are hardly any foreign investors, like Ahmed mentioned. For example, foreign investor participation, like I mentioned earlier in my answer as well, in Pakistan and Sri Lanka, is still very low. Even in Vietnam, which has been so attractive in the media, and a lot of everyone's talking about Vietnam being a manufacturing beneficiary of the global supply chain shift. Foreigners are less than 10% of the turnover of the market, basically. So I mean, if the dollar does strengthen, then so the impact on the local currencies in our markets should not be that much from a capital flight perspective. I think, and again, also brings us back to my earlier point that many of our markets are more domestic focused, more insulated from what's happening from a global trade perspective. So if anything happens to if something does happen to their currencies from a depreciation perspective or large depreciation perspective, it's more from their domestic policies, like Pakistan, current account deficit going from 2% to 6%, or Sri Lanka having some political crisis where it affects tourism sector, or Bangladesh, like we saw in the last couple of months because of political crisis. You've seen FX flows, reduce, etc. So I think I'm not so concerned about, say, in the next 1 or 2 years, because of if the investors are correct that dollar is going to get stronger, that'll affect some of our markets. I'm not so sure about that because, like I said, many of our markets have entered their own positive economic cycle, which is not so much linked to what's going on in US trade policy. And yes, you'll have normal depreciation like for any emerging market, 4 or 5% a year. But I'm not concerned about 20% depreciation or 25% depreciation in the next couple of years, say in the case of Pakistan, Sri Lanka, or Bangladesh. So from that perspective, I think even the dollar gets stronger, say in the next 1 or 2 years, I think our returns will still be pretty strong.
Okay, thank you. So pretty soon, 10:15 in Hong Kong. One last question. It's a little bit out of the box question, something more fun factor. And it's for Ahmed. Is Iraq safe to travel? What do I need to do security-wise, visa, etc.?
Well, the answer is it's extremely safe. For anybody who doesn't believe this, just type in on Facebook or anything an individual called Wandering Earl, who is actually one of those great travelers who goes everywhere, and he's been documenting that for the last few years. However, having said that, visa for most countries available in the airport. Okay, not super efficient, but it's available at the airport. One can get it there. There is no security that I can think of. It's always historical. People always sort of see still are living in the past, so you see most foreigners and most advice is quite negative. Most embassies live in super secure compounds. However, for me, I've been sort of coming back and forth in Iraq and spending a great deal of my time since 2017. The last couple of years, 3 years, it's incredibly normal, and that's what happens with stability. Countries go back to normal. Every country that had a conflict goes through conflict for a very long time, and then it's over. But the outside world takes a very, very long time to accept that. So basically, whoever's interested, give me a buzz. If I'm there, would love to meet you and show you the country. Otherwise, you can see it on your own. So thank you for that question. And
the best way to travel to Iraq now is via Istanbul or Dubai or Doha, I guess. Huh?
Yeah, there are no direct flights to Baghdad from most places, but for example, Istanbul, there are direct flights and many flights a day. Same thing from Jordan, same thing from Abu Dhabi, Dubai, as well as Qatar. And I think of the European countries, Austria flies to Iraq. But very, very straightforward. I mean, it's very, very easy.
Yeah. And can you repeat again this blogger or on Facebook you mentioned?
Yeah, it's called Wandering Earl. So Wandering, and Earl is EARL.
Earl.
He travels all over the place. Currently, he's I think in somewhere in Africa right now. I saw him, but he travels a great deal to Iraq, and he's taken foreigners all the way from top to bottom of the country. And also, surprisingly, that even in mainstream media, there was a report a few weeks ago in CNN, I think, that said about, look at these foreigners who are traveling in Iraq, and when you see them, they go, oh yeah, it's normal, and they go, people, yeah, it's been normal for 5 years. However, people still remember the messages of 10, 15 years ago. And honestly, if anybody has time, check some of the reports that we did on showing the images of Baghdad and so forth. It really is, for me, it's very normal. But for most people, it will probably be a shock.
Okay, great. Thanks a lot. This concludes our webinar today. And since we still have some unanswered questions, we will answer them directly by email. And if you have further questions, you can always reach us by email. I hope you enjoyed this webinar. We will continue to hold quarterly webinars in the future, and we will announce them in our upcoming monthly newsletters. Kung Hei for Joy, Happy Chinese New Year, and our best wishes for a healthy and wealthy year of the snake from the entire AFC team. Good night.